Hey everyone, welcome to second part of our video on data center stocks to benefit from AI boom in India. In the first part of the video, we discussed what exactly is a data center and how exactly it works. If you haven't watched the previous video, kindly watch it first to get a proper understanding of data center value chain. In the first part, we also discussed the growth drivers for data center in India. Now in today's video, we'll discuss the key listed companies in Indian data center value chain. Also, since no theme is completely risk-free, we'll also cover key risk and data center growth thesis. So watch the video till the end. Alright, let's get started. Let us start with the most obvious part of data center, the actual computers. As discussed, there are three types of IT equipment: servers, storage system, and networking gear. Unfortunately, Indian companies have almost no major presence in this core layer. For instance, GPUs are the core of computation and it is completely owned by NVIDIA. However, there are a couple of opportunities in this segment. First is NetWeb, India's only NVIDIA OEM server partner. It manufactures server storage and AI compute systems domestically. Plus, it is also a beneficiary of PLI scheme. So when a hyperscaler builds an AI data center in India and needs India-made server, there is essentially one name, and that is NetWeb. And it is also clearly reflected in company's financials that has grown exponentially. That also got reflected in share price. I remember covering NetWeb long back at very low levels. Unfortunately, the biggest issue today is that NetWeb is trading at very high valuation. By the way, I'm closely tracking NetWeb quarter results in my exclusive weekly video series where I track nearly 200 companies, including few other data center companies as well. And I also share my own investment strategy in terms of what I am buying or selling and my thought process behind the decision. Again, the idea is not to give buy or sell call. The idea is to share my own investment thesis. See, the fact is that majority of you would have a job or business and would not get enough time to do research for market. And that's where I try to add value, as I spend nearly 8 to 10 hours in market research on a daily basis. Okay, moving on, second company in IT space is E2E Network. It is basically a cloud infra company. Think of it like this. If you are a startup or an AI company or even a mid-sized enterprise and you need powerful computer with GPUs to train AI model, now you have two choices. Either you buy expensive hardware, set up your own infra, manage power, cooling, maintenance, which is quite complicated and capital intensive, or you rent it. So E2E provides that rental model. They offer cloud-based GPU compute. That means you can log in, deploy your AI workload, train your model, run inference, and pay for usage. You don't own the machine. You just use them. But the catch is, E2E is infrastructure heavy business. They have to invest in hardware and hardware depreciate. Technology evolves fast. Its financials are also very volatile. Its revenue has grown nearly 5 times between 21 to 25 and margins expanded significantly that resulted in exponential profit growth. However, trailing 12 months has witnessed sharp fall in margin that resulted in degrowth in operating profit, and high depreciation resulted in negative profit in trailing 12 months. Its stock has also reflected the same pattern when growth was exponential till November 24 and then it witnessed massive correction. So on one side, there is high growth potential for E2E network with rising demand for cloud infra. It also comes at the cost of high volatility. After compute, second critical layer in data center is power infrastructure. If IT equipment is the brain of data center, power infrastructure is the heart. Without power, nothing works, not for a single second. Now in the first part of the video, we discussed the entire power value chain within data center and how the power is stepped down, stabilized, and distributed within the data center. Now the question is, which companies play a critical role in this value chain? So first company is Hitachi Energy, an Indian subsidiary of Japanese company Hitachi. It makes the massive transformers that step down 220 kilovolt power to let's say 11 kilovolt or 33 kilovolt so it can enter the facility safely. Their specialization is in high voltage range like 132 kilovolt to 400 kilovolt, the largest, most technically complex transformers. Very few companies in the world can make these, and that scarcity is their moat. Financially, its revenue growth is modest, but margins have expanded that resulted in solid growth in profits. Especially trailing 12-month growth is exponential, and this is clearly reflected in share price that has jumped exponentially. Again, the catch is crazy valuation. But it's amazing how market is paying a high premium to Hitachi and it is trading at an all-time high in spite of this weak market environment. That shows the inherent strength in stock, and market is expecting solid growth in coming quarters. Now, once high voltage power enters the facility via Hitachi's transformer, it needs to be stepped down further from 11 kilovolt to 415 volt or 230 volt at multiple points inside the building before it reaches the equipment. So one of the companies, Shilchar, that makes these smaller distribution and specialty transformer. Think of them as secondary transformers inside the facility, not the big one at the gate. Again, its revenue and profit growth is extraordinary, and that got reflected in share price. However, there's a good correction from June 25 highs. Valuations are also reasonable. Now, once the power enters into the facility, it needs to be distributed into data center that is spread across thousands of square feet, and it needs to be controlled. We need to be able to switch sections on and off for maintenance. If there's a fault in one room, you need to isolate it instantly without taking down the entire facility. If a circuit is drawing too much current, you need automatic protection that trips before a fire starts, and that is done with switchgears. So here you have three companies competing head to head. ABB India, that is Indian subsidiary of Switzerland-based company ABB, Siemens Limited, Indian subsidiary of German-based company Siemens AG, and Schneider Electric, Indian subsidiary of French company Schneider Electric SE. Now, ABB operates strongly in high voltage and medium voltage segment. It includes your transformers, substations, grid automation, and switchgear. In data center, its role is largely at the power backbone level, where it ensures reliable transmission, voltage control, and protected distribution from the grid to the campus. ABBs also offer products that act as both switchgear and UPS. That is the next in the value chain. Financially, ABB revenue growth is decent, nothing exponential, but its margins have expanded big time that resulted in very high profit growth. However, December 25 has witnessed fall in margin that resulted in degrowth in profit. ABB share has grown exponentially, but then it corrected nearly 50% from peak. But now stock is showing recovery. The catch is, in spite of this fall, valuations are not cheap. Then Siemens Limited provides switchgear, building electrification, smart infrastructure, and automation system. Within data center, it plays a role in power distribution and building level electrical system that include monitoring as well as control. It sits between grid level infra and internal facility management. Financially, company has grown at average rate, but its share price has shown solid growth, although there is a good correction since December 24 high. Next, your Schneider Electric goes deeper inside the facility. Beyond switchgear, it is strong in UPS system, PDUs, rack level power distribution, and precision cooling. Financially, company has grown at fantastic rate and got reflected in the share price, although there is a good consolidation in last 2 years. Again, valuations are expensive. Apart from these three Indian subsidiaries of global players, we have one Indian company that sits into the intersection of distributors and switchgears. It's CG Power. When power comes from grid at high voltage, transformers step it down to usable levels like 33 kilovolt or 11 kilovolt, and that's where your CG Power plays a role. After that, switchgear distributes and protects electricity across different sections of the facility. In simple terms, CG Power is a power distribution and voltage management player within the data center value chain. Now, I don't know how many of you are aware, but CG Power has been one of the biggest turnaround stories. At one point in time, CG Power was struggling badly with losses. But Murugappa Group acquired it in September 20 and it changed its fortune. Company's revenue more than doubled and operating profit jumped exponentially from 2020 lows. That got reflected in share price, which simply exploded. Although there is a solid consolidation since October 24 high. Again, from valuation point of view, stock is expensive. Now, once the power reaches every part of data center, the next step is to ensure 100% uptime. You can't afford a few milliseconds of downtime because that can crash the server, corrupt the database, and halt all transactions. Hence, you need UPS. So here, again you have Schneider Electric, ABB India, and Siemens India. Now the catch is, UPS is good to provide the uninterrupted power for few minutes. But what if there's a major fault or a storm or transformer failure that takes hours to fix? And that is where your diesel generator comes into picture. Here you have two companies, Cummins India, which is Indian subsidiary of US based company Cummins, and KOEL, that is Kirloskar Oil Engine Limited. Now Cummins India is the gold standard for mission critical backup power. When a data center engineer is specifying backup power for a facility that cannot fail, Cummins is often specified by name before the tender is even issued. The service level across India is deep, and in the generator business, service is almost as important as the product itself, because a generator that is not maintained is a generator that will not start when you need it most. Then Kirloskar oil engine is the strong domestic alternative. More competitive on price, growing capacity, and a trusted brand in the mid-range genset market. Cummins' revenue growth is decent, but profit growth is sharper due to margin expansion. Its share price has also grown exponentially and still trading near all-time high. Again, valuations are elevated. Kirloskar oil engine has also witnessed sharp margin expansion and hence solid earning growth that got reflected in share price. Valuations are again on higher side. Now, a normal enterprise data center may consume 10 to 30 megawatt, and diesel generators are perfectly fine there. But modern AI and hyperscale campuses are now talking about 100 megawatt, 300 megawatt, even 1 gigawatt power requirement. At that scale, you need gas turbines. A gas turbine allows the operator to generate power on site instead of depending fully on the grid. Manufacturing it requires precision engineering, specialist materials, and deep electrical engineering. It is not a commodity. And this is where your TD power system fits into the data center value chain. They do not make the complete generator. They make the alternator, the electricity generating heart that goes inside it. The demand for TD power is clearly visible in financials. Revenue growth has been solid, but net profits have simply exploded due to margin expansion. And that also got reflected in share price. Again, market is already valuing the company at higher valuation. So if I quickly summarize the beneficiary within power value chain, you have Hitachi India, Shilchar Technology, followed with ABB India, Siemens Limited, Schneider Electric, CG Power. Then you have Cummins India, Kirloskar Oil Engine, and then you have TD Power. Now every computation generates heat, and in a data center where thousands of servers are running at full capacity around the clock, the amount of heat generated is extraordinary. Hence, you need massive cooling systems that can remove heat faster than it is generated. So first company in this segment is Blue Star. It is the most focused Indian listed company in precision DC cooling. Blue Star has dedicated data center vertical, not just HVAC, that is heating, ventilation and air conditioning for offices. As liquid cooling adoption grows in India, Blue Star is positioned to be a key domestic supplier. Again, its growth has been phenomenal in the last 3 to 5 years, but trailing 12 months has witnessed fall in revenue and profit growth. Share price has seen exceptional growth, but stock has been consolidating since January 25 high, but still valuations are expensive. Then second company is Voltas. For Voltas, data center is one of the business vertical. Company is well placed for large campus cooling on hyperscale projects given their project execution capability and brand trust. Although less specialized than Blue Star in precision cooling, but benefit from scale and relationships. Its earning growth has been average, especially sharp degrowth in trailing 12 months due to unusually cool summer last year. Share price has also corrected since September 24 high. Again, valuations are expensive. Then third company is KRN Heat Exchanger. KRN is not a pure data center cooling specialist, but it benefits indirectly from growth in large cooling capacity expansion, particularly in hyperscale and AI data center. Company recently got listed in 24, so we don't have much historical data, but recent earning growth has been great. Share price has already doubled from listing and valuations are again expensive. Next, you need to build the physical data center, and this is where the EPC players comes in. So here first company is L&T, which is India's engineering conglomerate and the only Indian company building NVIDIA AI factories. Although L&T's data center contribution is very low as a percentage of total revenue, but data center is a high growth vertical. Also, L&T is most credible EPC contractor for any hyperscaler building in India. Second company is Techno Electric. This is most pure play DC EPC in India, and its revenue and profit growth is also explosive. Its share price also reflected that growth. However, it fell down significantly from October 24 high. Now from valuation point of view, you won't find it expensive. But please note that EPC companies never command very high valuation because they are highly working capital intensive and margins are sensitive. So its return ratios are not great. In short, EPC business look great in expansion cycle, but they carry hidden balance sheet and margin risk when condition changes. Then you can also consider one real estate company, Anant Raj, that is quickly pivoting into DC. Already owns large land parcels in Haryana, which is ideal geography for Delhi NCR data centers. Having said this, real estate companies carry massive execution risk. Finally, you have cables and wires that carry the data between servers, racks, and you have fiber infra that carries the data between cities and countries. Here, cables and wires include three companies, Polycab, KI Wires, and Apar Industries. All three of them have immensely benefited from capex cycle in India in last 4-5 years, which is clearly reflected in their financials. Polycab revenue and profit growth have compounded at more than 20% rate that got reflected in share price as well. Likewise, KEI has also grown at 20% rate and share price reflected the growth. Apar Industries specializes in cables as well as transformer oil and hence grown at even faster rate in last 3 years and share price reflected that growth. Now data center continue to create demand for cables and wires. Only catch is all three of them are trading at elevated valuations and market is already discounting near-term positive news. Having said this, cable and wires can continue to show momentum. Now within fiber optic and network infra, you have Sterlite Technologies and Tata Communication. Sterlite Tech is one of the world's top 10 optical fiber manufacturer. Every data center requires extensive internal fiber cabling and India's data center boom is a direct volume tailwind. Only catch is fiber optic is a commoditized business and this is clearly visible with volatility in company's margin. Revenue growth has been flat and operating profits have fallen significantly. That was visible in company's share price. However, recently there's a massive price volume action in last few trading session and that suggests some big positive news coming for Sterlite Tech. Now data center needs massive low latency, high speed bandwidth and Tata Communication owns and operates a large global fiber backbone and submarine cable network spanning across Asia, Europe and America. Without that backbone, the data center cannot serve global traffic. Although financially, revenue growth in last few years is very low and net profits have actually fallen. And share price is also consolidating for a long time. But valuations are quite reasonable at EV to EBITDA of 11. Now let's look at key risk in data center growth thesis. So first risk is capex cycle risk. Today, data center theme is looking very promising because world's top hyperscalers are projecting a capex of $600 billion in 2026. Basically, there's a capex super cycle happening in AI and cloud investment. But this capex is happening at the cost of free cash flow. As long as revenue growth justifies it, market rewards it. But what if AI monetization takes longer? What if enterprise IT spending slows? What if ROI on AI infra is lower than expected? And if hyperscalers reduce capex even by 15-20%, data center companies can see moderation in growth and valuation derating. Today, market optimism for data center is at its peak because of massive capex. But the moment things slows down, things can turn negative very fast. So you must keep this risk in mind before investing your money. 2026 may be great for data center companies, but remember that it is only because of high capex. The moment capex slow down, things can become difficult. Then second risk is supply demand risk. Today, every major player from hyperscalers to real estate developer is rushing to build new data center because the demand for cloud, AI and storage is exploding. But what if supply grows faster than demand? We have seen this before in Indian real estate. Developers built shiny new apartment and office towers, but demand could not keep up. That resulted in vacancy, falling lease rate and poor return. The same thing can happen in data centers. If too many racks come online at the same time, utilization will lag. If hyperscalers or large client delay expansion, operator may be stuck with empty capacity earning nothing. Remember, data centers are not cheap warehouses. They are ultra capital intensive. Then there is another angle. There is concentration risk. India's data center demand is driven heavily by a handful of big hyperscalers. Amazon, Google, Microsoft. If even one of them slows expansion, it can leave entire facilities underutilized. Fourth risk is valuation risk. Let's be honest. Data center related companies are already well discovered. Majority of them have already jumped multiple times since 2020 COVID lows. And they are all trading at premium valuation. The reason is because their earning growth in last 3-4 years has been phenomenal and near-term earning growth expectation is also very good. So market is paying a premium. However, the moment capex cycle slows down, revenue growth can fall, operating profit can also reduce and earning growth can reduce. In that case, market sentiment can change quickly and valuation can derate sharply. And when valuation derate, stocks can fall sharply. So valuation risk would always exist. Then fifth risk is environmental risk. Data center consume massive electricity and in many cases significant water for cooling. In water-stressed regions like Chennai, Bangalore, this can attract regulatory scrutiny, local resistance or usage restriction. Then rising temperature also increase cooling cost, which again impact operating margin. On top of that, AI-driven data centers are extremely power intensive and if energy is coal-based, ESG pressure and carbon-related regulation can become a constraint. And then sixth risk is supply chain and geopolitical risk. Data center has a massive supply chain. For instance, a large portion of high-end chip manufacturing is concentrated in Taiwan, particularly with companies like TSMC. If geopolitical tension escalate in Taiwan region, or if there is any major disruption, whether political, military or logistical, GPU supply can get constrained. And without GPU, all AI data center expansion slows down immediately. Even beyond Taiwan, the semiconductor value chain span across multiple countries. Any disruption in this chain can delay deliveries and push back deployment timelines. So if you step back and look at the entire picture, data center is a massive theme in India, with hyperscalers committing 600 billion in 2026 in AI and cloud infra, and 3.5 times jump expected in data center capacity in next 5 years. It's not a single stock story. It's a full ecosystem story. From servers to GPUs to transformers, switchgear, cooling system, EPC companies, cables, fibers, global connectivity. Today, entire data center supply chain is going through a massive capex super cycle. However, let me be very honest, none of the data center stocks are looking cheap or even fair. Data center has already been a well-discovered theme. Sure, the next 3 to 5 year growth is looking solid, but today all data center stocks are trading at PEG ratio of more than 2. And as we have discussed, there are multiple risks, including your capex cycle risk, geopolitical risk, environmental risk, and so on. So at the moment in 2026, data center stocks are certainly looking in momentum, but if things does not go as per plan, data center stocks can derate. So if you are willing to invest, ensure that you track the capex cycle and near-term demand for data center stocks. So this is it from my side. Now you tell me in the comment which data center stock or specific part of the data center you find most promising. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.